Imagine it's 1999. You're a 34-year-old school teacher in Phoenix, Arizona. You've just received a small inheritance from your grandmother, $1,300. It's not life-changing money, but it feels like a beginning. It feels like possibility. Your coworker tells you about a technology fund. She shows you the returns, 47% last year, 62% the year before that. She explains that the internet is changing everything, and that ordinary people like you can finally participate in wealth creation that was once reserved for the elite. You invest the entire amount. By March of 2000, your $1,300 has grown to nearly $2,000. You tell your husband that maybe you'll add more. Maybe this is how people actually build wealth. Maybe you finally figured out the secret that nobody taught you in school. By October of 2002, your account is worth $347. You don't check it again for 11 years. This story is not unique. It is repeated in every generation since public markets opened to retail investors. The names change, the assets change, the pitch changes, the outcome does not. And here's what no one tells you. The outcome was never supposed to change. Because investing $1,000 is not the same activity as investing $1 million. It's not even the same game. It operates under different rules, different constraints, and different mathematical realities. The financial industry has spent 8 decades convincing ordinary people that these are the same game with the same odds. They are not. This is not theory. It's documented history. And once you understand the actual mechanics, once you see the system as it was designed rather than how it's marketed, you can navigate it, not because you've learned a secret, but because you've stopped believing the comfortable fiction. The standard narrative goes like this. Investing has been democratized. In the past, only wealthy families could access financial markets. Brokerage fees were prohibitive. Information was gated. The average person was locked out of wealth creation. But technology changed that. Commission-free trading apps put markets in your pocket. Index funds eliminated the need for stock-picking expertise. Financial education became available on YouTube and podcasts, in best-selling books written by friendly advisors who genuinely seem to want to help. The message is clear and repeated constantly. Start early, invest consistently, and time will do the heavy lifting. The power of compound interest, the miracle of the market. $1,000 today could be tens of thousands tomorrow. This narrative is partially true, and partial truths are the most effective deceptions. Yes, barriers to entry have fallen. Yes, transaction costs have collapsed. Yes, information is more available than at any point in financial history. But availability is not the same as advantage, and access is not the same as equity. What the democratization narrative omits is the structure of the game itself, who designed it, what it optimizes for, and why the house edge operates differently at different capital levels. Here's the first thing you need to understand about investing $1,000. You are not the customer, you are the product. When a trading app offers you commission-free trades, it is selling your order flow to high-frequency trading firms. Those firms pay for the privilege of seeing your trades before they execute. They make fractions of a cent on each transaction. Multiplied by millions of users, this is worth billions annually. When a mutual fund advertises professional management, it charges fees that compound against your returns year after year. A 2% annual fee on $1,000 seems trivial. $20, who cares? But here's the math. Over 30 years, a 2% annual fee consumes roughly 40% of your potential returns. On a $1 million portfolio, that's hundreds of thousands of dollars transferred from your retirement to the fund manager's paycheck. On a $1,000 portfolio, the absolute number is smaller, but the proportional damage is identical. And because you're starting with less, you have no margin for error. Every percentage point extracted is a percentage point you cannot compound. This is not a bug in the system. This is the system. The financial services industry generates approximately $500 billion annually in the United States alone. That money comes from somewhere. It comes from the aggregate wealth of participants. It comes disproportionately from participants who don't understand the fee structures they've agreed to. There are 3 mathematical realities that govern small dollar investing. None of them are explained in beginner finance books, because explaining them would reveal the uncomfortable architecture of the entire system. The first reality is the asymmetry of percentage gains and losses. If you invest $1,000 and lose 50%, you now have $500. To return to your original position, you don't need a 50% gain. You need a 100% gain. You need to double your remaining capital just to break even. This is not intuitive. Most people carry an unconscious assumption that gains and losses are symmetrical. They are not. Losses always hurt more than equivalent gains help. This mathematical asymmetry means that volatility itself is a cost, even if you never sell at the bottom. The second reality is the tyranny of time horizons. Large investors can wait. They have other income sources. They have diversified holdings. They can hold positions through multi-year drawdowns without selling. A wealthy investor who bought stocks in October 1929 could theoretically hold through 1954, when the market finally recovered its pre-crash peak. 25 years. They had the resources to wait. A small investor often cannot wait. Life happens. A medical bill, a job loss, a car repair. When you need money, you sell whatever you have. And you sell at whatever price the market offers that day. This is not a failure of discipline. This is the structural reality of limited capital. The average holding period for stocks among retail investors is approximately 10 months. Not because they're impatient, because they need the money. The third reality is the information lag. By the time investment advice reaches retail channels, by the time it's packaged into a book or a YouTube video or a financial planning seminar, the opportunity has usually already been priced in by institutional investors who had the information earlier. This is not conspiracy. This is simply the physics of information flow. Professional investors pay for data terminals that cost $20,000 annually. They employ analysts. They have relationships with company executives. They trade on the aggregate of millions of data points that you will never see. You're playing poker against opponents who've already seen your cards. This dynamic is not new. It has replayed with remarkable consistency across every era of expanded market access. In the 1920s, stock market participation surged among middle-class Americans. New brokerage houses opened across the country. Buying on margin became normalized. Newspapers ran daily stock tips. The narrative was identical. Ordinary people can now build wealth like the Rockefellers and Morgans. Between 1925 and 1929, the Dow Jones Industrial Average nearly quadrupled. Millions of small investors poured their savings into stocks, many borrowing against the value of their shares to buy more. On October 29, 1929, the market lost 12% of its value in a single day. This was not the bottom. By July 1932, the Dow had fallen 89% from its peak. 89%. The small investors were margin called. They were forced to sell at catastrophic losses. Many lost not just their investments, but their homes, their farms, their life savings. The large investors, those with capital reserves and no leverage, bought their discounted shares. The wealth transfer was astronomical. The same pattern emerged in 1999 and 2000. The dot-com bubble brought millions of new retail investors into the market. Online trading platforms made participation frictionless. The NASDAQ quintupled in 5 years. Technology stocks were the future. When the bubble collapsed, the NASDAQ lost 78% of its value. It did not recover to its 2000 peak until 2015, 15 years. But here's the detail that rarely gets mentioned. Many of the institutional investors who promoted those technology stocks to retail clients had already sold their positions. Internal emails from major brokerages, released during subsequent investigations, showed analysts privately describing stocks as junk and dogs, while publicly rating them as strong buys. This is documented. This happened. And it happened again in 2021. A new generation of investors, armed with commission-free apps and Reddit forums, poured billions into meme stocks and cryptocurrencies. The narrative was rebellion against institutional finance. The reality was a liquidity event for early holders. When the speculative froth evaporated between 2021 and 2023, approximately $2 trillion in cryptocurrency value disappeared. Much of that value transferred from late retail buyers to early institutional sellers. The game remains the same, only the interface changes. So, who actually profits from the small investor? First, the financial services industry itself. Brokerages, fund managers, financial advisors, or robo-advisors, trading platforms. These entities extract fees in dozens of ways. Expense ratios, advisory fees, spread markups, payment for order flow, account maintenance fees, withdrawal fees. The median American family holds approximately $5,000 in financial assets outside of retirement accounts. The financial services industry collects fees on that money every year, regardless of performance. Second, large institutional investors benefit from retail participation because retail investors provide liquidity. When a hedge fund wants to sell a large position, it needs buyers. Retail investors serve as the absorption mechanism for institutional supply. Third, the financial media benefits. Financial news networks, investing websites, and personal finance influencers generate revenue from attention. That attention is monetized through advertising, often from the same financial services companies that extract fees from viewers. Notice the circularity. The financial industry pays for advertisements that encourage people to invest. Those people pay fees to the financial industry. A portion of those fees funds more advertisements. You're not outside this system watching it. You're inside it, and it is designed to process you. The cost is borne by exactly who you would expect. Small investors pay the price, not because they make bad decisions, not because they lack discipline, but because the system structurally disadvantages participants with limited capital. A study by the University of California examined the trading behavior of 66,000 households over a 5-year period. The finding: the most active traders underperformed passive investors by approximately 6 percentage points annually. The more they traded, the worse they did. This was not because they were stupid. It was because transaction costs, bid-ask spreads, and poor timing accumulated with each trade. Activity itself destroyed value. Another study by Dalbar, a financial research firm, tracked investor returns versus market returns over 30 years. The finding: the average equity investor earned approximately 4% annually, while the S&P 500 returned approximately 10% over the same period. You eliminate stock selection risk by owning the entire market. You eliminate timing risk by contributing consistently. You minimize fee extraction by choosing the lowest cost options available. You neutralize your behavioral impulses by not watching. This is not exciting. It is not even particularly interesting. But it is the strategy that has historically delivered the best outcomes for participants in your capital bracket. Let me show you why with actual numbers. $1,000 invested in 1990 in a low-cost S&P 500 index fund with an expense ratio of 0.04% would be worth approximately $20,000 today. That assumes no additional contributions, just the initial investment left untouched for 34 years. The same $1,000 invested in the average actively managed mutual fund with an expense ratio of 1.0% would be worth approximately $14,000. The difference, $6,000, went to fund managers. Over longer time horizons, the gap widens. The mathematics are remorseless. Now here's the part that actually matters for someone with limited capital. $1,000 invested once is not enough. The strategy that works, the only strategy that works reliably for small investors, is consistent contribution over time. $100 per month invested in a low-cost index fund for 30 years at average historical returns of 7% after inflation becomes approximately $122,000. Not because of any clever strategy, not because of stock picking or market timing, simply because of mathematics. Time and consistency, combined with minimal fee extraction, produce results. This is the actual secret. And it's not a secret at all, it's arithmetic. If the answer is so simple, why does the financial industry make it seem complicated? Because simplicity generates no fees. If you invest $100 per month into a Vanguard total stock market index fund, Vanguard earns approximately 30 cents per year on your money. That's it. That's the entire revenue. If a financial advisor manages the same money, they earn approximately 1% annually. On $10,000, that's $100 per year, 300 times more. If a trading app convinces you to trade frequently, each transaction generates payment for order flow, more activity, more revenue. The complexity of financial advice is not designed to help you. It is designed to justify fees that would otherwise seem absurd. Think about what that means. Every time you hear about a sophisticated strategy, about portfolio optimization, about sector rotation, about tactical asset allocation, ask yourself one question. Who earns a fee from this complexity? The answer is usually not you. Let me be concrete about what to actually do with $1,000. Step 1. Open an account at a low-cost brokerage. Vanguard, Fidelity, and Charles Schwab all offer accounts with no minimums and no maintenance fees. You will encounter other options with flashier interfaces. Ignore them. The interface is designed to encourage activity. Activity is the enemy. Step 2. Purchase a total market index fund or exchange-traded fund. In the United States, options include VTI, ITOT, or SWTSX. The expense ratios on these funds are between 0.03 and 0.4% annually. On $1,000, that's 30 to 40 cents per year in fees. Step 3. Set up automatic contributions. Even $25 per month, if that's what you can afford, changes the mathematics over time. The contribution itself matters more than the amount. You are building a habit that will compound over decades. Step 4. Do not check the balance. This sounds trivial. It is not. Behavioral economics research consistently shows that more frequent monitoring leads to worse outcomes. You will see losses. You will feel the urge to act. Acting is almost always the wrong choice. Step 5. Extend your time horizon mentally. Do not invest money you will need in the next 5 years. If you do not have 5 years, this is not the game for you. Put the money in a high-yield savings account and accept the lower return in exchange for stability. That's the entire strategy. It fits on an index card. Now, let me address the objections. Some people will say, but what about employer retirement matching? If your employer offers a retirement account match, that is free money. A 50% match on your contributions is an immediate 50% return. No investment strategy in history can compete with that. Max out the match before you do anything else. Some people will say, but what about high interest debt? If you carry credit card debt at 18% annual interest, you should pay that off before investing. No reasonable investment will reliably generate 18% returns. The mathematics favor debt elimination. Some people will say, but what about emergency funds? If you have no cash reserve, investing is premature. 3 to 6 months of expenses and accessible savings is not optional. It is the foundation that allows you to hold investments through downturns without panic selling. Some people will say, but what about real estate? Real estate is a legitimate wealth building strategy, but it is not accessible with $1,000. Real estate requires substantial capital for down payments, repairs, and carrying costs. That is a different game for a different capital level. Some people will say, but what about cryptocurrency, about individual stocks, about options trading? You can do those things. Many people do, but understand what you're actually doing. You are speculating, not investing. Speculation can generate returns. It can also generate catastrophic losses. The mathematical expectation for retail speculators, documented across multiple studies, is negative. If you want to speculate, allocate a small percentage of your capital that you are genuinely willing to lose. Do not confuse speculation with wealth building. They are different activities with different risk profiles and different expected outcomes. Let me tell you about a man named John Bogle. In 1975, Bogle founded Vanguard and created the first index fund available to retail investors. He was mocked by the financial industry. The fund was called Bogle's Folly. Why would anyone want to accept average returns? The financial industry's opposition was not ideological. It was economic. Index funds threatened the fee structure of the entire investment management business. If people accepted market returns at minimal cost, what justification existed for expensive active management? Bogle's answer was the data. Over any sufficiently long time period, most actively managed funds underperform the index. They charge higher fees and deliver lower returns. The average conceals the exception, but the average is what most investors experience. 50 years later, index funds hold approximately $12 trillion in assets. Bogle's idea, dismissed as folly, became the most successful investment innovation in retail finance history. He died in 2019. He never became a billionaire. He could have. The structure he chose for Vanguard, owned by its funds and thus by its investors, meant that profits flowed back to participants rather than to executives. This was not an accident, it was philosophy. In investing, Bogle wrote, "You get what you don't pay for." That single sentence contains more genuine financial wisdom than most libraries of investment advice. I want to address something that no financial guide will tell you. Investing small amounts of money feels pointless. You put in $100, it grows to $107, then it drops to $93. The fluctuations seem arbitrary. The amounts seem meaningless. This feeling is accurate. In the short term, small investments do not matter. The returns on $1,000 will not change your life this year or next year, but that is precisely why most people quit. They expect investing to feel meaningful immediately. It does not. The significance emerges only over time, over decades, and only if you do not stop. This is the actual barrier. Not knowledge, not access, not fees. The actual barrier is the psychological endurance required to continue an activity that feels meaningless for years before it begins to compound into significance. The financial industry knows this. It exploits this. It offers excitement, activity, the illusion of control, the dopamine of trades and price movements. It offers distraction from the boring truth. The boring truth is that wealth accumulation for ordinary people is slow. It is tedious. It is unsatisfying in the short term. And it works. Zoom out for a moment. Why does a society need ordinary people to invest in financial markets? The answer is that modern retirement systems depend on it. The shift from defined benefit pensions to defined contribution retirement accounts transferred investment risk from institutions to individuals. Companies no longer promise you a pension. They offer you a tax-advantaged account and tell you to figure it out. This transfer was not neutral. It shifted hundreds of billions of dollars in risk from corporate balance sheets to household balance sheets. And it created an enormous new customer base for the financial services industry. You are expected to be your own pension fund manager. You are expected to understand asset allocation, sequence of returns risk, and safe withdrawal rates. You're expected to manage your own retirement with the same sophistication as professional actuaries. This expectation is absurd, but it is the system we have. Understanding this context matters because it reveals the stakes. This is not a game you can opt out of. If you want to retire with any financial security, you must participate in systems designed by and for people with far more capital than you. The question is not whether to play. The question is how to minimize the damage. So let me state the constraint clearly. If you have $1,000 to invest, you are operating under limitations that cannot be overcome by strategy, by cleverness, or by information. Your capital is too small to diversify meaningfully across individual positions. Your fees, even minimal ones, compound significantly against small balances. Your time horizon may be interrupted by life circumstances beyond your control. Your psychological reserves may not withstand multi-year drawdowns without capitulation. These are not failures of character. They are structural constraints imposed by your position in the capital hierarchy. The appropriate response is not despair. It is clarity. When you understand the actual constraints, you can work within them rather than against them. You buy the whole market because you cannot research individual stocks competitively. You minimize fees because you cannot afford the compounded drag. You automate contributions because you cannot trust your future psychology. You extend your time horizon because you have no other edge. This is not strategy. This is survival. Here is what no financial advisor will tell you directly. Investing $1,000 will not make you wealthy. Read that again. $1,000 invested at historical average returns for 30 years becomes approximately $7,600. That is not retirement. That is a used car. The people who build wealth through investing do not do it through one-time contributions. They do it through consistently investing large amounts over long periods. They do it through high incomes that allow substantial savings rates. They do it through inheritance, through equity compensation, through business ownership. The mythology of the ordinary person becoming wealthy through market investment is largely mythology. It happens. But it happens far less frequently than the financial industry's marketing suggests. This does not mean you should not invest. You should. The alternative, holding cash while inflation erodes its value, is worse, but invest with clear expectations. You're not going to beat the market. You're not going to retire early because of clever stock picks. You are going to participate in economic growth over decades, capture your share of that growth minus fees and taxes, and end up better off than if you had done nothing. That is a realistic expectation. That is achievable. Anything more is a sales pitch. Let me return to the school teacher in Phoenix. She lost money in the 2000 crash. She stopped investing for 11 years. When she finally checked her account, it had recovered to just below her original investment. 13 years for nothing. But here is what actually happened in those 13 years. She paid off her credit cards. She built an emergency fund. She started contributing $150 per month to her retirement account through her employer, capturing the full match. She chose a target date index fund because it was the default option, and she didn't want to think about it. By 2019, her retirement account held just over $200,000. Not from brilliance, not from timing, just from persistence, from automatic contributions, and from not watching. She will not be wealthy, but she will not be destitute. She will retire with dignity, with enough. That is what success looks like for most people. Not the magazine cover, not the early retirement, just enough. The financial industry will not celebrate this outcome. It generates minimal fees. It makes for boring stories. It does not justify expensive advice, but it is real, and it is achievable. And for the vast majority of people with $1,000 to invest, it is the only honest path forward. The pattern is clear. The financial system is designed to extract value from participants. The extraction is proportionally higher for those with less. The information asymmetry favors institutions. The fee structures favor complexity. The marketing favors activity. Against this system, the only defense is simplicity, low costs, broad diversification, consistent contributions, extended time horizons, and the psychological fortitude to ignore the noise. This is not inspiring. It is not exciting, but it is true. The question is not how to get rich investing $1,000. That question accepts a false premise. The question is how to participate in a system designed to disadvantage you while minimizing the damage and capturing what growth is actually available. History suggests that most people will not do this. They will seek excitement. They will chase returns. They will pay for advice that costs more than it provides. They will buy high and sell low, not from stupidity, but from fear. You do not have to be most people. But being different requires you to see the system as it is, not as it's marketed. It requires you to accept boring truths. It requires you to resist the pull of hope and the push of panic. Whether you can do that is not a question I can answer. Only time will tell. But at least now you know what game you're playing. This is historical and educational analysis. It is not financial or investment advice. Past performance does not guarantee future results. Consult a qualified financial professional before making investment decisions. This channel exists to reveal the patterns beneath the marketing, the structures beneath the stories. If understanding systems matters to you, subscribe. Most people never see these dynamics until they've already paid the cost.